Hey, I think it's actually working. Oh my god, finally. Took like an hour. Jeez, I was supposed to be on like 30 minutes ago, and now I'm finally here. Anyways, what's up, guys? It is Ted with Bodies and Wicks. Nice to see y'all. Wonderful, wonderful, wonderful Friday night, shall it be? To those that watched my video yesterday, and I'm not cracking a beer, by the way. I'm cracking an energy drink. I don't drink beer. To those that watched my video yesterday, and I said, hey, check me out and follow me on TradingView. I do apologize that I did not have a TradingView trade today. I may have not. The only thing is that I actually slept through my alarm, and I didn't wake up for work in time. So typically I work from like, I work from 6 a.m. to 3 p.m. Today I worked from well, I got up late, so I ended up making it at work at 8 and got there till 5. But you know, by the time I usually am there for 2 hours and nobody's there, I get to watch the market and, you know, check it out and see what's going on. I had no time to do that this morning, so unfortunately I didn't get to get a good chance and make a call. But however, I did see some cool things that happened, some integration things, I guess you could say, where you could definitely see that smart money is in play in both the crypto market and in the Forex market at the same time. And especially the timing of it. Some crazy things, well, not crazy things, but some things I'm going to show you here in just a second that were a little bit interesting, to say the least. So, and if you guys like technical analysis, if you guys are fans of smart money, if you guys are fans of trying to learn how to make money on your own without having to use a signal service, just by knowing how the markets work, that's what I try to provide. I am not unique in any way. There are many others like me. I'm not trying to say I'm the first one trying to do this. I do think there's not too many people trying to teach smart money in the way of the Forex world and then bringing that to crypto. I don't think there's that many people doing that. So I do believe I am one of the very few that are actually trying to do that. There are people in the crypto world who do know what smart money is and understand that it's there. They just don't know how to trade it, right? So I believe I'm bringing that value. I'm bringing the value of knowing how to trade smart money in the crypto world, right? So if you do like these things, what I would encourage you to do is go ahead and hit that like button, hit that subscribe button, and I shall be back with plenty more of things that you can enjoy and well, why didn't that work? No, I took off my logo stamp. That's what I did. And I need to take off. Alright, guys, I am new to this, so give me 1 second while I try to figure out what I did wrong. And that's it. All right, never mind. Okay, there we go. There it is. All right, so sorry about that, guys. Again, new to this whole podcast thing, trying to do this on my own, and nobody trying to help me. So getting down to the nitty-gritty of stuff, adding some things in here and there, and just having fun with it. That's all. So here, let's get to the charts. Let's get to the nit-grit of things. We shall see what we have going on in just one moment. I mean, give me just a minute. Because we have some other things that I want to get to. All right. And, as you can see, I did not, well, I tried to prepare as much as I could for this, but I didn't prepare enough, evidently. Okay, give me one moment. And we are going to do something here really quickly. I'm going to look up some Bitcoin stuff. Make sure I have that all prepared. There we go. All right. I think we are ready to rock and roll. Sorry about that, guys. I do apologize for the lateness and inconvenience. But I think we got everything solved, and I think we got everything ready to go. So, all right. First, what I want to do right now is I want to start you off with something that you may not be familiar with, especially if you're in crypto, right? The dollar, right? So we have this thing called the dollar, and what it does is, you know, it kind of contributes to pricing in different various areas of the market, and primarily in Forex. You know, what it will affect is, you know, the GBP USD, the Euro USD, things like that. What we don't think about it, you know, affecting is how it affects crypto, right? So, and the way it affects crypto is when we literally look up things in crypto, right? We look up things like Ethereum is ETH USD, so ETH to the US dollar, or, you know, or ETH to the you know, the euro if you're trading the euro, or ETH to, you know, the pound if you're trading the pound. They do have those as well. So you basically your transaction rate, not transaction rate, your foreign exchange rate, basically, or your exchange rate, to simplify it, would be that of you know, that kind of pricing, I guess you could say. So that being said, what I want to bring your attention to is this morning. So yesterday morning, right, what I had called for, and I called for, this was the call of the day, was that I saw it coming up and I saw this equal high, and then I did see that there was a bearish breaker over here, and I said as soon as it breaks that high, it's going to break that breaker and it's going to sell, right? And then I said to buy GU and EU at the same exact time. And to show you what I mean, I'm going to take you to my trading view page. Here is my call, right? Buy EU and GBP as soon as the DXY breaks the high, and this was yesterday. And if we click on this idea, right? So this is the cool thing about trading view. It gives you the idea when you made the call, and then you can hit play and see what happened afterwards. So I hit play, and then it didn't go this way, it went this way. It went straight down. So indeed, I was correct on my call. And so what happened with EU and GU? Well, as you can see, as soon as you bought, right, boom, came up 10 pips, right? And then here you go. Here's another 15, right? And then here we go. Here's another 15 on GU. This one's on EU. This one's on GU. And then here we go on GU a little bit later. We get up to 25. And then here we go a little bit later on GU. We're up to 40. And then here we go a little bit later on GU. We are now up. Well, this was actually 25 after the other 25, I want to say, because this was what was this price on here? 3.5 at 3.651 is what this price was, and the earlier price We get back here. I think 3.561 is right here. So another 25 pips on top of here is basically what I was referring to. Because I had added in another buy, right? Because I knew it was going to get above a specific high. So, and then all in all, at the end of the day, you know, what happened with GU right now, I think right here, I think is at 64 pips. And then it eventually got all the way up here to it actually got all the way up here to almost 3.71 is what it almost got to. So it was about almost 100 pip day. It was about 90 something pips on GU. EU was kind of similar. I think it started off at 50 pips and eventually got a lot higher. I didn't document the rest of EU just because it took a lot longer to get there. And I should have noticed that. And when I noticed that, I should have realized what was happening is that EG was falling at that time, right? So that's one thing I didn't see and I should have picked up on. So if I was to go to, let me just grab a chart here really quick, and let's go to EG. See where it's at. I usually have it. Here we go. So that would have been yesterday morning around 7 o'clock. Yep, there it is. See, I should have been paying attention to this because the GU just took off and left EU just sitting there. So at this time, what was happening with EG was that since the pound was acting more in force, it was forcing this down while the euro was staying still. So there was another way we could have made money here, and I didn't think about it until later. Usually I play all three of these just because if you know how EU is working, how GU is working, then you can know how EG is working as well. So now that all being said, let's go back to the DXY, right? And so let's take a look at what happened this morning. I know there's a lot of lines and stuff in the way, but they mean something. And so what happened this morning, right, is it came up to here, right, about 8 o'clock this morning, right? It came up to here, and then it had another high, right, equal high, right, that it was going to try to break. And at this time, I was at work. I was watching it. I just wasn't vocal about it, and I didn't have enough time to say, hey, it's going to go higher, sell, right? I just didn't have the time. I was at my computer. I was doing so much stuff. I only had enough time to just put in my sell and then just hope for the best. So I put in my sell because, boom, as soon as I did that, it went higher. And then next thing you know, look at this right here, probably is almost at its peak, right? I want to say somewhere around in here, 9:45, 10 o'clock. So I want to mark that, right? Well, if it would stay still, right around there, we get pretty much the peak of the dollar, and then it falls back, and then it kind of continues up for the rest of the day. Now the thing with the dollar is it going to continue on, right? Because now we have this big huge wall, right? So what this wall is this wall was a liquidity run, right? And smart money, what had happened is that this was automatically pumped up for anybody that was shorting in the game, right, to get knocked out, right? Because what happened is that this door was open, right? It opened up as a gap, and so many people shorted, and so many people shorted, it kept going up, and people were shorting it because they kept thinking it was going to come down and fill the gap. So smart money ran it all the way up and took anybody shorting out, right? And so that's what it did. So this is liquidity run. So now what we're looking at is this right here as a liquidity pool. What I mean by liquidity pool, I mean it pulls toward this area, right? Get a little bit bigger. Text blue. All right, let's go with green. Why not? And then liquidity. Yeah, I say reach, liquidity pool, whatever. They're both the same thing. So, and there's one right above it as well. So, the thing is the dollar going to try to continue to try to pull up that way, or has this wall of liquidity possibly going to make it retract? And I think, to be honest, it's probably going to make it retract, because if we look at it, especially in a almost like seasonal sense, or if we look at this in, you know, a 1 hour, you know, the thing is that with a dollar, it is, you know, it did have its time up here, right, to where it kind of in June through whatever it was, you know, in June it came down through here, right, in July, stay sideways for a very long time, and then it was right at the end of November, right, boom, it fell down. The same time that the dollar started falling, right, was what? The same time the crypto market started going crazy, right? The dollar's falling, the crypto markets are all going crazy. This is because there is a direct relationship to these markets, right? So this is something we have to consider and be careful of. A lot of people don't like to think about the dollar and how it relates to the crypto markets. Well, it directly affects the crypto markets, because guess what? What are you taking your dollars and putting them into? You're putting them into crypto. If you're buying crypto, you're literally exchanging that money for crypto. If you're worried about crypto, right, and you don't think that it's going to get as high as what you think it is, what do? You withdraw it, right, and then it goes back into the US dollar, right, or it goes back into the euro, or it goes back into the pound, whichever currency that you're using. So that's how it affects these markets. And this is why I wish more people would have a little bit more faith in the crypto markets and keep them in, because as you can see at 10 o'clock, around 10 o'clock, right, whenever it does have this high and then bounce back, let's roll over to Ethereum. What happens at 10 o'clock? We have this low bounce, right? Now the good thing is that the dollar, even after it bounced, right, it continued upward, which could have honestly sucked Ethereum downward, right? So there could be other factors in the market that were causing it not to go as far down, right? So but if you look at the inverse relationship, right? So how do you look at an inverse relationship? What you can do is you can literally just hit add and hit DXY, right? And then it's not really doing anything, is it? Well, I thought it would have been a little bit more exciting than that. I mean, it does, like, once you get back into here, right? But I think it's once Ethereum kind of took off and it left the dollar behind, it was just overshadowing. Oops, sorry. It was just overshadowing the dollar to where it doesn't really have a relationship with the dollar anymore, right? Now it's at, geez, sorry, I keep hitting buttons. I mean, sometimes you have to get really, really close over here to even get some kind of relationship with it, but yeah, it's not giving me the inverse relationship I wanted, unfortunately. So I'm just going to go ahead and take that off. But as you can see, it does have some effect on, the crypto market. I was thinking what it was going to do is it was going to show you that the dollar would rally up and go down, right? And then come back up and then, go back up higher. So if we were to turn, flip the dollar basically. Right. Then it would almost look like Ethereum, basically. And it kind of does. So if you think about it, this right here would be, the Ethereum high. And then you have this would be the short-term high that it gets. And then you come all the way down. And then because the dollar is at a low, right? So the dollar didn't get lower than its lowest low. Ethereum didn't get higher than its highest high, right? And then it comes down, and then boom, hits a high, right? It actually gets above these equal highs here. So that causes a huge spike down, right? And the Ethereum drop, right? And then, oops. But then it kind of pulls up, and then now it's just kind of drifting up. And now the whole drifting up is part of, kind of the algorithmic portion, I guess you could say, of the trade. So I'm not saying that it's 100% directly related, but you do have to think about the dollar, right, and how the dollar relates to crypto markets, right? Because like I said, how are you buying your crypto? You're buying them with your dollar. So more than likely, whenever you're doing this with your exchanges and you're putting your money in and then you're taking your money out, it's going to directly affect the dollar, because the dollar, whenever you put your dollar into the crypto system, whichever crypto that you prefer, if you prefer Cardano or Zcash or Dash or Bitcoin, or if you're a Doji fan, then that whatever you put into that system, it is going to affect the dollar. And we definitely saw that again in November, whenever all the crypto markets were on the huge rise. The dollar market was, it was just tanking. It was tanking. I mean, just tanking. I'm gonna take a look, see if there's any chats. No chats. Okay. All right. So that being said, what I want to do is now that we have understood that now the dollar is also pretty much what's the word I'm looking for? Controlled. It is very much controlled, right? So not so. I mean, definitely there's controlling of the printing money, right, and the Fed and everything like that. Quantitative easing or quantitative ease, whatever it is, which I found out recently, is not meant to stimulate basically what they're doing is they're buying bonds and whatnot. So it does the opposite of what it does. So it makes the government bonds more bullish, which would make the yields actually bearish. And price chases the yield, right? If you know anything about intermarket analysis, you kind of know these things. Price chases yield from government bonds. So if the bonds are bullish, which means that the yields are going to be the inverse, which are going to be bearish, that means the currencies are actually going to be getting less value, right? Now, that less value, is that coming from directly from the bonds? Yes. Is that value also coming from people jumping to cryptocurrencies? Yes. There's ton of things as to why you know, these things can occur. Now, that being said, what I wanted to do was look at smart money moves within you know, the crypto markets itself. So here in Ethereum, I have a blank slate. I don't have my typical one up. My typical one that I usually use is this one here. So as you can see, this is a lot of mumbo jumbo that you probably don't want to go through. So instead, I picked instead of Coinbase, I picked Bitfinex. Only because actually this one had the better price, so that's one of the reasons why I picked it. But I'm sure it's going to give me the same kind of stuff. So when I am looking at this, right, and whenever you think yourself, you know, whenever something gets to a high, it gets to a rally, right, and it starts pulling back, right, it starts pulling back and it starts falling. A lot of people's intentions, or a lot of people's, you know, the FUD comes into play, right? Right, that's when everybody's FUD comes into play, and they go, "Oh my God, what do I do?" And they think they can sell, right, and then buy back at a better price. Usually, by the time they think they can sell, it's right at the time where it hits the bottom and it goes up, right? If you don't have any experience in these industries, typically that's something that would happen, right? I've seen it happen to myself a couple times, you know. I've definitely seen it happen to a lot of other traders. You know, they think they know what they're doing, but I mean, in the crypto game, you know, if you're just selling, you know, what you own, and then, you know, buying back at a different time, that's not really considered trading. That's more just, you know, selling your assets and trying to buy it back at a better price. That's, I wouldn't really consider that trading at all. Trading is more along the lines of, you know, if you have the MetaTrader 4 app and you know, you're doing CFDs to where you're basically buying contracts, you know, by the hundreds. But you know, you can buy a contract by the hundreds with, you know, 10 cents. And then so with Ethereum, with every dollar you make a dollar, right? So it's kind of like it's almost like you know, what's that called? There's one site that has it. I forgot what it's called, but it's called like Rumble or so, not Rumble, but I don't know. But basically, it's battles. Battles is what they called it. Now, I think it was Bitstamp or something like that. Basically, to know you where you can play futures, right? So that's what trading really is. Your trading is about options. It's about futures. It's about, you know, trade your contracts for difference. That's what trading really is, because you're putting more at risk, you know, for more return, right? If you're just, you know, buying Ethereum off, you know, Coinbase, and then you're waiting for it to get here and you're selling it and you're buying it back, you know, down here, you know, that's just buying and selling it of an asset. That's not really trading. And I hate to burst your bubble if you're one of those people that thinks that you're like this amazing trader, and this is what you do. But that's not really considered trading at all. Give me 1 second. I will be right back. I had forgot something that I need that is very important. And I'll be right back. It won't take anything but like 5 seconds. And I'm back. I told you it wouldn't be that long. Sorry about that, guys. Alright, I want to see if there's anybody on my live feed. Alright. No questions yet. Okay, so, back to Ethereum. Okay, so, what I want to show you is how to anticipate these drops, right? These smart money drops, right? Because this is definitely an institutional move, right? So, what you want to do is first, what I want you to do is have a fib, right? I want you to set your fib to a specific thing, right? So, I'm just going to throw this out here. Oops, didn't mean to do that. Didn't mean to do that. I have fat fingers, I swear. Right, so what you want to do is you want to take this fib, right, and you want to have it for your settings inside, you know, your 0 to 1. What you want to have is you want to have first a 0.705, right? That is considered your money maker. That is where price wants to retrace, right? And I'll show you this in just a second. Of course, you want to have your 0.5. You always want to have a 50% of your current situation, because price likes to retrace immediately back to 50% of candles sometimes, and if it does and it rejects off of that, then you know that you're either in a bullish or a bearish scenario depending on which direction it is going. And also you can measure order blocks like that, and there's a lot of things you can do with the whole 50%. So always have a 50 in there. You always want to have a 618 or a 62. I like having a 6.2 just because it gives you a little bit, especially if you want to place a trade, you know, it allows you a little bit more leeway into that trade, and you know, in case you were to have a spread or something like that. And then you also have to want a 0.79. The reason you want to have a 0.79 is because if you ever get to something that has a point, like generally, you know, the most explosive moves come from things that are about 80%. So 0.79, or if you want to, you could do 0.8 as well, right? Because it could get to 0.8, but 0.79 would be definitely the closest it would get to 0.7 or to 0.8. Or you could do 0.795 if you want. It doesn't matter, right? And then for your extensions, right, what you want to do is you want to do extensions of 0.27s, right, and 0.62s. Now, I do mine negative, right? And the reason I do mine negative is so they'll go in the direction that I do my fib, rather than having them positive and then having to flip my fib around just to get the extension, right? I don't like doing that. So I put in my negative, and it's the exact same concept, does the exact same thing. So negative 0.62, I should have negative 0.27 somewhere. Not for sure where I have negative 0.27, but oh, there it is. Yeah, negative 0.27. Then negative 1, and then negative 1.27, negative 1.62, negative 2, yeah, and you keep going. Or you could do the fives as well, right? And you could add in the, you know, the 5 marks in there too. But these are the ones that I usually like to use, just because this is almost always where it goes, right? So now that we have the fib established, right, what I would like you to do is understand that there is balance, right? And then where there is unbalance, it's going to try to rebalance, right? And so, as you can see, you know, this is kind of coming along, you know, just kind of doing its thing, you know, comes up here and it drops, right? And man, I mean, I know about you guys, I was getting excited when it was like 450, you know, something like that. And you know, I had money in, and I was still putting more money in down here. And then I did not expect this at all, and when it did, I was like, hallelujah. But of course, with anything like this, you have to expect a big retracement, right? And anybody that says that it's not going to retrace is flat out lying to you or trying to sell you something. So how do you predict these retracements will fall back? All right, first, what you have to do is find the first candle, right? That is going to be a displacement candle. What I mean by displacement candle is going to be a candle that is going to basically shift away from the norm, right? So, and if you can't spot it, I can right now. I'll show it to you in just a second. What I'll do is I will put a little ellipse over it, right? So it's this candle right here. That is your displacement candle, because you have it's going along, and then it drops down just a little bit, and then boom, it goes up. From that point on, it just rides, right? So now that you know that, now you know where to place your fib, right? So what you want to do is place your fib underneath that candle. Actually, you might want to place it underneath the candle next to it, the red candle, because that's the last push down, right? And then you want to drive this to the top. And now what do you get? It drops down into this golden zone, right? This is why you want to have this 0.62, the 0.705, and the 0.79. Because you're going to look for entries in this area. This is going to be the area to where it's going to fall back into, as long as you know where to look for, right? And I showed exactly what to look for. And even then, this could have happened right here too, right? So it jumps up really, really high. Boom. Falls back down. Where does it fall back down to? Boom. 0.75. You could have entered then, right? Boom. All right. Got my entry on that one. Now we're going long again, right? And then it gets all the way up to here to the top. And then now you just wait for it to fall back. And it's almost as back as to where it was before. Boom, you enter again. Now you're in a safe spot. Right, now you're good to go. Right, so that is basically showing you how smart money operates. This is their way of doing things, right? And the reason I know this is because I have paid attention to a lot of people online who have taught this, primarily Inner Circle Trader, and some others, but Inner Circle Trader is definitely the one who showed me this type of fib and what to look for. There has been some others that have showed me, you know, price action will definitely, they say 75%. You know, I've heard people say that, but 75% is a little bit too far. It's generally about more like 65%. You know, is where it comes back to, but 70.5 is almost right on the dot every time. It's just it's uncanny how almost it just gets back to that. So now that we know that happens, what's the next thing to look for? Well, you want to see if there's any bearish breakers. What do I mean by bearish breaker? A bearish breaker is going to be something that is going to be at the top of this apparatus, right? And it's going to be your last up push candle before your down push candle, right? Because the last up push is where the smart money is going to buy, right? Or force the market to go in the buying direction to make people think that it is going to buy, right? And then they know at a certain point it's going to sell. Now, the funny thing is that that certain point that it's going to sell is also going to be probably one of these fib extensions. Let me get in really close here and let me see if it is going to work. So we're going to draw the top of fib down here to down here. Where does it come up to? Boom. Right in that golden zone. Again, just past the 70.5, almost to the 7.9 or the 0.79. So again, it comes to this area right here. So, you know, it fakes people out and, you know, pushes them up into this, you know, this market to where they think they're going to sell or buy anyway. And then smart money turns around and then boom, drives it right back down. And why is it in these areas? Because that's considered a discount. It's considered a discount if you didn't get in this first move, right? Smart money gets together and they go, oh, you weren't in that? Okay, well, here, we'll allow you to participate in the next one. You know to participate, and then, you know, they work together and they, boom, they drive it up. And then, of course, it gets in this area, and then all the rest of smart money, boom, drives it down. And, of course, they drive it down hard, right? Where do they drive it down to? Well, they know exactly where it's going to go to because they had it planned in the first place, right? So, now, if you don't believe me in all this, I'll show you examples in the in the Forex world, in the equities world, you know, in the indices and things like that. This is not a phenomenon, right? That's happening in Ethereum or Bitcoin, because I can show you this happening in Bitcoin too. You know, it happens everywhere, right? This isn't just unique to the crypto market, right? And that's why I made this video, is because I think the crypto people don't understand that the price action that happens is very, very, very similar to the Forex market. So I wish more crypto people that were crypto enthusiasts, that really love crypto and that did technical analysis, right, would actually go to understand the Forex market first, right? If you go to the Forex market first, right, you're going to see a lot of these similarities in the crypto market. They're not two separate things. They're two separate entities or two separate asset classes, which is awesome, because before, whenever I was doing this, is kind of a side note, you know, whenever you do your trading plan as try to be a professional trader, you have to do intermarket analysis, right? You have to write kind of an extensive detailed plan about intermarket analysis, about seasonality, about certain things, because there are seasonalities of different markets and how they operate. And the thing is that, the four asset classes are, currencies, equities, bonds, and commodities. And equity stocks is what I mean. So stocks, bonds, currencies, commodities, right? Those are the four asset classes. Well, now there's a fifth one, right? Cryptocurrency. I mean, I guess it would still fall under the currency category, but I don't know if I actually would, because it's not, it's not, it's a different kind of currency. It's not the currency that we're used to. It's not centralized currency, but again, it's operating in the same manner that the rest of these, operate. I mean, you'll see these things here that I'm talking about. You'll see these in the soybean market. You'll see these things in cattle and beef. You'll see it in oil. You'll see it in gold. You'll see it in all these different types of markets, right? So if you actually study the way the other markets work, you'll actually have a really good understanding about how to do technical analysis in the crypto markets. It's very, very fascinating, actually. So now that I say that, all right, so where's it going to go to next? I'm sure you guys are done here about me mumble. All right, so this is your last up down move, right? So this is called your bearish breaker or your bearish order block, right? Because this is your last up candle, right, to where the market pushes it up and then pushes it down. So what do I mean by this, right? By pushing it up, Well, let's say you have very, very large pockets, right? Right, just like these huge institutions do, right? They have extremely large pockets. And so what do? They will actually put in a trade like this, right? To where they just put in a little bit of money, right? And it's enough money to get people to, you know, start buying, right? And that's all they have, right? And but by the time, you know, it gets to the point to where it starts selling, they don't have time to get out of this trade because, you know, it could be a lot to handle, depending on how they did it, because they could start, the way they could do it is they could be putting in chunks at a time, right? You know, they could be putting in, you know, 5,000 contracts, 10,000 contracts, you know, 12,000 contracts, something like that, something to boost it up a little bit. And, you know, and by the time it, you know, it could be up to here where it is, and then people start seeing that, and then they start buying, right? And so whenever they start buying, they stop, they're buying themselves, and so now all of a sudden they're starting to sell, right? And they're starting to sell, and they're starting to sell, and then so then by the time it actually evens out, boom, it starts going back down. So now these people that have engineered this, right? Now they have a short position, right? And then they started their short position here, and of course they, like I said, they knew where it was going to go. So they got out right here, right? Because they knew it was going to drop off at that, you know, 0.75 level. So now they just made all this money going all the way down in that short position. Boom, now that they've hit that, they are done, right? So let's move this over. Boom, now they're done with that trade. So now what do they have to do? Now they're in the red though, right? They're in the red. So what, you know, but again, since they're in the red, they knew where it was going to drop to. What did they do? Right? They put in another long position right here. Right? Where is it going to go to? It's going to go to this first area, to where they first pushed it up in the market, right? To make people think they're going to buy before it came back down. So they knew where it was going to go down to. They bought right here, right? And they pushed it all the way up to where this bearish breaker was, right? And now that they are here, boom, they can close out. You know, this trade's already closed because they already made their money off that. Boom, now that they're in the red, right? And it came back up. They're not in the red anymore, so now they can close out this trade. Oops, not that one. Now they're not in the red anymore, right? They can close out this trade. But now they've also made their money going up this way, and now they can close out that trade. So now they have made all the money they need just by faking out the market, right? It's exactly what they do. And this happens in every single asset class. And to give you a bit of it, why don't we go to bring up DXY, and let's just go to NASDAQ, right? Let's go to NASDAQ.